Hey folks, welcome to CFO Chat, your front row seat with the Chief Finance and Value Officer anytime a corporate action happens. This is where you get the full breakdown. Stanbic Holdings numbers for FY25 are out, and as always, we're privileged to have Dennis Musau with us. Dennis, karibu sana.
Asante sana.
Dennis, F25, very strong balance sheet story.
Yeah.
P&L has quite a bit of lethargy, very strong on the impairment recoveries here. Help us understand, when you take a broad-eyed bird's view on F25, what are your key highlights?
So, I'm glad you start by saying a very strong balance sheet story.
Very strong balance sheet story.
Because that is the input.
Yeah.
The P&L is an outcome. The input, the sweat, the effort of the 1,300 plus staff that we have in the bank, and the partnership we have with Standard Bank Group is really in driving the inputs. So what's our story in 2025? 19% balance sheet growth and growth in the right areas. 19% customer assets, 18% customer liabilities, and showing trust in the business. If you then pierce that a little bit more, 70 billion lent to SMEs, 7,500 new SME customers, 8% growth in customer numbers, 12% growth in digital transactability or digital transactions. That is a story. Then you are operating in a market where central bank rates go down 225 basis points.
In 1 year.
In 1 year. You're also operating in the market where T-bills, in response to that directional view, go down 800 basis points from 16% to touching 8%, 7% towards the end of the year. You're also in a market where FX margins more than half.
Yeah. So
you need to double your activity to stand still. So actually, the story I see in our income statement is a story of character. The character of resilience that is in our team, despite all these challenges in the pricing, the margins, etc., etc. The character to deliver that. And it's not just top line. Yes, you've got some challenges on the top line. It's the character to manage your cost of operations, to drive efficiencies. It's the character to drive recoveries on the credit line. You mentioned it, 48% down year on year. 57 or 56 basis points of credit loss ratio. That really is the story of the income statement. So actually, I mean, we've been discussing this for 3-4 years. This year is the proudest results I have presented. And I'll tell you why. In Q1, we were 18% down year on year. At half year, we were 10% down year on year.
Actually, you had some massive clawback in H2.
Yes. So when I talk about character in the team that is Stanbic, it's exactly what I'm referring to.
But the problem there, Dennis, is this. Yeah. And Dennis, unfortunately,
yes,
we have spoken for so long. So when I was
that is fortunate, though.
When I was analyzing your earnings, if we were in the football pitch,
yes,
you engage the defensive play too late in the year, in my own analysis. Your funded income is taking a hit. Your non-funded income doesn't kick in as fast as it should. Now, there are a number of things to unbundle there. First of all, when we sat here 12 months ago,
yes,
Dennis,
yes,
I asked you, the FX tide has receded.
Yes.
What's your game plan? You told me now it's volumes, less margins.
Yes.
Even on the volumes, look at your numbers now. Yeah. Quite a hit there.
You see, I think, Julians, you remember our conversation, but you remember part of it. I think it's Chinua Achebe who said, and he was giving a bird's analogy, said, when the shooter started shooting without missing, we learned to fly without patching.
Yes.
right? The reality is the markets have shot without missing on the pricing side. Let's just agree that's par for the course. We've had to learn how to do business in that environment. In 2023, we had very, very good earnings from FX.
Absolutely.
FX was 9 billion shillings in our income statement. That was 21% of our total income. In 2025, FX income was 3.9 billion shillings. Out of 39 billion of income, that's 10%. Now, 6 billion of FX earnings have gone away. But we've learned to fly without patching. Why? 52% growth in our volumes. Yeah. We needed to more than double our FX volumes to stand still. Well, actually, if we doubled, maybe someone would have asked us, what were you doing before? Because what is this new market that you've
unlocked,
you've created? So I think, and I still believe that the response that we've given to the tough market environment is really appropriate for the challenges and the pricing compression that we've seen. Did we engage the accelerator a little too late? When we started last year, private sector credit growth was negative 2.9%.
Yeah.
So we were part of this bus, which was actually on the reverse gear.
And now, you're trying to move forward.
And you're trying to move forward. So you can run as fast as you can inside the bus, but that's your reality. You're still going backwards. And what I'm proud of is that when the markets have turned and we've seen 6.9% growth, we've actually delivered 19%. So we've actually outpaced the bus when it engaged the drive or the go forward gear. Would I have loved to see that come much earlier? Yes, but it's not a Stanbic's market. It is an industry.
Fair point there. And looking at your P&L, Dennis, interest income expense, you must have done some very aggressive work in unwinding the expensive deposits. Give us more context into that.
Yeah, so our interest income on customer loans went backwards about 10.7 billion in gross numbers. Our interest expense went backwards 11%.
Yes.
And I mean, we've said this before. You're funding your balance sheet for purposes of on lending to the customers, and it is my job, particularly my job, to watch at what costs we are funding that balance sheet. Now, if you look at NIMs, 5.7 versus 5.6, to maintain that, we have had to do a lot of work on the cost of funding. So
absolutely,
we unwound some expensive fixed deposits. We unwound some expensive call deposits. It helps that these are short dated, so you can deal with the repricing fairly quickly. But the underlying story is when we closed last year, our current assets, savings accounts, current account, savings accounts, what we commonly call CASA. As CASA, was touching on 70%. We've now improved that to 81% by year end. Yeah. So what that means is we had more transactional deposits than we had in the previous year. And that explains the dip in interest expense. And that is what I call character in the team that we have in the bank.
But is 80 now your sweet spot, or would you like to ratchet it up further?
I've seen banks go to 95%.
Absolutely.
So one day, I think we want to get to 85 and then progress to 90%. But 81% is an A when I was in school. So I think while we are looking at A star, we are comfortable with the A.
And as you did excessive work on the deposits, your loan book is up by a tidy sum. And I'm very curious as to the unbundling of that jump because the nature of Stanbic Bank as we know it is that you are not really retail skewed, if I could put it that way. Help us understand the buckets.
I don't know who has told you about our nature. We have to be relevant in this market. We have to be relevant in this market, and I think you can't be relevant in this market if you're not doing some work with SMEs, you're not doing some work with retail customers. So I'm very happy that our customer numbers have now crossed the 300,000 mark. I know it's still small, but 300,000 customers is better than the 190,000 we discussed about 3 years ago. So I think that's positive. I'm very happy that we created 200 new homeowners. That is a story that once I have, let go of this suit and the position that I hold, I think that is something we'd like to be proud of. Yeah. That we help people with real things that help them and they value. I'm proud that we've brought on board 7,500 new SMEs. We've lent 70 billion to them. We continue to do a lot of work with our foundation, supporting MSMEs, etc., etc. So we are very relevant, and that is our nature. But we have a history. We're coming from a history where we were largely corporate investment banking heavy, and just because of the chunk of those of that business, it continues to be the leading business that we have. Yeah. And you're right, a lot of that balance sheet growth we saw was mostly actually on the corporate investment banking, alongside the comments that I've made. So what's the character of the 41 billion that we added onto the balance sheet? About 45% is big infrastructure type lending that we did, whether it is supporting roads programs, whether it is supporting electricity generation and supporting distribution, whether it is basically supporting institutional drives that are relevant for the market, and staying on course with the areas the government is driving growth and therefore private sector is following. There is also a bit of a lumpiness because of our supporting of the G2G, something that we remain very proud of. We did support our oil marketing companies before the G2G arrangement came through. We continue to support those oil companies now, and we see ourselves supporting them into the future. That's another 30%. The remaining 25% is where you see our SMEs, our commercial clients, family-owned businesses, our retail customers, you and I borrowing to buy a plot of land here, build a home, etc., etc. So the architecture and the nature of the business is relevant to all Kenyans.
Now that you've mentioned it, Dennis, what's your exposure on G2G from letters of credit perspective?
So we closed 2025 with about 3 LCs on the balance sheet. And they tend to be chunky, so plus or minus 30 billion. We closed the previous year with, I think we had one at the time, the others had matured, so that's a 10 billion. So you almost have a 20 delta in there. But even if you remove that, you're still at 11% growth on your balance sheet compared to the 6.3 that the market printed. So I'm happy, it's double.
Okay.
Yeah.
Your asset quality, Dennis, is one of the bright spots in this set of earnings. And when you gave us a breakdown, what really impressed me is that you look like you have a very firm control, one on recoveries and two on the flow towards stage 3. Maybe just help us understand that, and especially within the context of the credit risk everybody's crying about in this market.
So our credit quality is one of many strengths we have, and I think there's a few other things that we do very well, but credit quality is one of the things that, and it shows. Our CLR 0.57%. When I analyzed the market in Q3, we were actually leading. When I analyzed our NPL ratios in Q3, we were the second best in the industry. There is a story behind that. That story is around diligence.
And also the nature of the clients.
Yeah. diligence in, but we banking Kenyans. We're banking Kenyans. Everyone is banking the same market. But the differentiation is in the diligence of underwriting, staying with the client through the cycle. Because I know we've discussed this before. But when you lend to a customer to buy a home, or for 20 years, or to invest in an infrastructure project that is going to unwind cash flows over a 20, 30-year period, there will be summer, there will be winter.
Yeah.
So how you stay true, engage the customer. We had this unfortunate instance last week, Friday, where we had floods in Nairobi. And one of the things our teams did was to call some of the customers that may have been impacted and to say, how are you? It is that endears these customers to come and say, you know what, rates are falling. I've got a little bit more in my wallet because I'm not paying a lot of interest. I can now redeem some capital, and that drives our NPL ratio. And then, when things go south, because as surely as the sun rises in the east and sets in the west, things will go south. When they go south, how do you engage the customer to discuss options of recovery? For the most part, would like to avoid litigation, would like to avoid ugly incidents in recovery, etc., etc. And we do that very well. 95% of the times, we sit down with the customer like we are talking now and say, hey, I thought I would do this business. It's not working. I had given you this collateral. How can we work together to unwind it because etc. Or how can we restructure this facility? I thought the cash flow would be $1 million per month. It's now 600 because markets have turned the way they've turned. Is there a way you can help me restructure so that I don't pay $1 million, I pay 500? We take pride in that because 30 years down the line, when that business has been passed to the second generation, it can trace its cradle to a conversation that they had with Stanbic Bank. That's really why we celebrate the 8%, not because it's better than market, but because it's a story of sustainably engaging customers to grow with them.
But then it's still on that point, you did mention that given where you are from an NPL ratio perspective, you feel that you've got the bandwidth and the scope to gauge on more risk in the market.
Yeah.
Is it an indication that in your own analysis, you're flying too below the industry radar of 15, 14%, and you feel that maybe you need to tick up a bit in that case?
You know, Julian, there's always more risk to take. And in fact, even if you don't take risk, it will come to you.
Yeah.
So do we want to grow? Yes.
Absolutely.
When you, and my colleague in the bank, Abraham, likes to say, when you eat like a rabbit, you poop like a rabbit. But when you start eating like an elephant, prepare. Right? It's not a very clean analogy, but the reality is, as we grow, and we are very ambitious and would like to grow, there is no debate about that. As we grow, we are prepared to take more risk. We are prepared to do things, to bank segments that we did not bank before. We now have the best banking facility offering for the public sector employees. Did you know that? No. We actually have the best in terms of rate and tenor. So any public, teacher, policeman, etc. Is this stuff that we did 5-6 years ago? Not necessarily. So we are prepared, and I'm not saying that is a riskier place. Of course, we will engage them. We will use our exercised risk management practices to manage that risk. But in growth, we are very clear that it will come with a bit of losses, and we're prepared for that. In fact, that is why we have more capital, despite the healthy dividend that we are paying, which we will talk about. We have 300 basis more capital than the regulator requires, because we think we will need to take some risk.
And speaking about the capital buffer and the fact that you are ambitious and you'd like to grow inorganic?
Inorganic
you really set yourself up there.
I think so. So our growth path, is, as we have discussed very many times, is organic, is partnerships, and is inorganic. This is far and few between. Opportunities will come at us, and we are always looking at them.
Yeah.
But I actually want to give you a story, because when you and I sat and discussed our growth approach, we were actually discussing the 2022 financial statement. It's the first time you asked this question. When you asked that question, I gave you exactly the same answer. We'll grow organic, inorganic, and we'll grow partnerships. And I told you that our focus today is to drive organic growth. Let me give you some numbers. When we had that discussion, our balance sheet was 390 billion shillings. Today, it's 541 billion shillings. So if you went to sleep after that conversation and you woke up today, you'd be asking me, which bank did you buy? Because that's 150 billion shillings. Yeah. That is a strong tier 2 bank. Right? At the time, our profitability was 9 billion shillings. Yeah. Now, it's 13.7. That is 4.7 billion shillings. That is a bank that is paying a lot of dividends. In fact, at the time, our shareholder value in terms of market capitalization of Stanbic Holdings was 40 billion. Yesterday, Stanbic Holdings was worth 101 billion shillings. Yeah. So if you went to sleep after I had that conversation with you,
I'd be waking up asking which bank was
and
acquired.
you woke up today and you found that the bank is worth 2.5 times what it was then, you would ask me, so which bank did you buy? Yeah. So I'm actually very comfortable that we continue diligently executing on our organic strategy, and that is why there are V in my title, creating value with what you have, even as we scout for opportunities for inorganic. And inorganic will happen. It will happen at some point. You have to get it right in terms of the synergies that you want to generate, what it is that you want to acquire, what is it bringing on board. You have to get it right in terms of your integration opportunities. Yeah. You have to get it right in terms of pricing. There's a lot of dynamics. But hey, while we look at that, I'm very happy with organic.
Dennis, I was quite surprised that between December and February, 90% of your disbursements were Kesonia priced. Yeah. When the industry seems to be leaning more towards CBR, help me understand your leaning towards Kesonia.
We remain true to what the central bank is trying to achieve. And I think we need to give a lot of credit and a lot of kind of accolades to the central bank for wanting to drive private sector credit growth. Is it double digit? Not yet. Will it get there? I think the trajectory suggests it's going to get there. What is that coming off? It is because of the continuous focus on what's going on in the market and using some of the tools they have to help the banks transmit that. Kesonia is one of those opportunities. Why were we able to transmit Kesonia? Because we were prepared. Yeah. We were actually very prepared. In fact, I dare say, we actually engaged the central bank much earlier and shared our view on the risk-based pricing as it was previously. Some of the challenges we had, some of the stickiness in the base, etc. The answer, I'm not going to take credit for Kesonia, but I think the central bank balancing everything, the feedback, etc. gave us this. When we asked the question, we were prepared for the answer. Yeah. So when the answer came as in, you can now use an overnight rate or you can use CBR, we were prepared, our systems are prepared. Please remember, 47% of our loan book is FCY.
Foreign currency.
That's on SOFA or SONIA.
Yeah.
So Kesonia
was not a struggle at all.
It was not very difficult for us to do. And what is exciting also is the conversations we had with clients. some of our big corporate clients, when we introduced this conversation, they said, you aren't saying anything new. We're used to SOFA, we're used to Sonia, so go ye, as long as you can actually demonstrate that you've computed Sonia fairly, etc., etc. So that transition for us was very easy. Now, there are some other instruments, for example, scheme lending, where you go and say, I want to bank the employees of this entity, and there's a standard, there are some agreements that you have. Those ones now we have had to manage differently.
Given how we have seen the foreign exchange rate over the last 18 plus months, are you still witnessing high appetite for your foreign currency lending? Is it tapering down? How is it playing out?
It's actually grown. So we are seeing a lot more. So why does it grow? What are the inputs to it? One is opportunities to invest for the customer. And I think those ones are there. Whether it's the big projects we're seeing, etc., there are opportunities there. Number two, it's the stability of the currency and availability of the currency. The fact that when I want to buy dollars to repay my facilities, I'll get them. Yeah. So that has helped. And then dollar rates have also been coming down. So all that has helped with kind of creating a fertile environment for that growth. So we have seen it grow in the book. I'm a little hesitant on what the Middle East situation might do in terms of is it likely to manufacture inflation and therefore rates start ticking up. It's one of those things that I have at the back of my mind to just keep on reflecting on. But suffice to say, good growth in that area.
Now that you've touched on the issue of the trend in the rates and the yields in the environment, the last I spoke to the governor of the central bank, which was the last MPC meeting, he indicated as far as the central bank analysis is concerned, the output gap is still in the negative terrain. There is still a lot of scope for further unwinding of the benchmark. Now, you've seen the yield compression and the impact on your numbers. Your NFI also had a bit of pressure. What's your game plan in 26?
Volumes. So you see, banks are commercial entities. And while we respect and have to respect the social contract we have with society to provide credit, we have to deliver a return to our shareholders. If unwinding of credit benchmarks comes with fulfilling that social contract and the commercial contract we have with our providers of capital, then that does help. If rates come down, and actually the governor is justified in saying that, because if you look at where inflation is, some of the metrics that they look at, if you look at where would like our private sector credit growth to be and where it is, there is fertile soil to take those actions. The one variable that we as banks and we at Stanbic are alive to is what does a falling rate present as an opportunity, as opposed to a reduction in margin. Reduction in margin, you can cry about it, but it will happen.
But it will happen.
It will happen. The question is, who now has more money or has more balance sheet buoyancy, is less leveraged in their balance sheet, has a bit of reprieve on their personal wallet to borrow, to build a home, to start a business, to buy a property, to buy a car, etc., etc. Those are the people we are talking to. Because when the reverse happens, the gains are on the margin. So when rates go up, you get margin gains, but the customers then walk away. Because they can't afford, they're stretched, they're looking for restructures, etc., etc. So what's our game plan? Talk to customers.
Okay. Our time is gone. Let's wind this down. On the efficiency side, for 3 consecutive years by my analysis, your cost to income is ticking upwards. Is this a pointer of investment pressure? Is it an indication that we sat back as management and felt our efficiency was too good to afford?
No. So our total costs, let's look at total costs only. In 2023, was about 17.8 billion. In 2024 was 17.7 billion. So actually went backwards. A little bit. There was FX help, but went back anyways. Now it's gone up by 2% to 18 billion. So from a cost management perspective, show me an organization that's managing costs as well as we are. But we also know that managing costs has never given a return. The pressure you're seeing on the C/I ratio, our cost to income ratio, is actually because of the revenue.
The revenue, yes.
Remember, in 2023, 41 billion because of the FX conversations that we had earlier. Then in 2024, 39 billion. And then in 2025, 38 billion. A big part of that taken away by the FX margins and the interest margins. So that pressure is actually, if the 41 had become 45 today, my cost to income ratio would be sub 40.
Yes, yes.
So I'm not too worried about the mechanics of the costs, and I'm very, very happy with the choice of investments that we've made. 2 years ago, we upgraded our core banking platform. Very happy with the outcomes that we are seeing there. 2 years ago, we released the latest version of our mobile app, which is very, very helpful to our customers. Currently, we are investing in a platform of our BCB customers. It's actually in pilot testing. We are going to be showing that up fairly quickly. We invested in a platform for our asset management business, a business that did not exist in 2020,
yes.
In 2024, before 2024. We invested in a fraud monitoring capability in terms of a system to actually look at Julian's account and say, Julian's doesn't normally withdraw money at 2 a.m. Stop this, because that is protecting value for our customers. Those investments, I'm willing to give up the cost to income ratio to make those investments.
The dividend, which is something which, of course, given the way we've seen the earnings, many who look at the P&L would ask, why are they bumping it up? But you look at the balance sheet and you see the story there. But please help us understand the dividend. You
see, this is the question I love most from this analysis of our earnings. You see, we are entrusted with people's capital. We have been given 75, 80 billion shillings by shareholders. And they've said to us, go and trade with this money. And then we come back at the end of the year and we say to them, guys, we lent 70 billion to SMEs. We allowed, or we helped 200 new homeowners to achieve home ownership. We facilitated a lot of credit growth in our balance sheet. So we grew the balance sheet. We provided employment and meaningful lifestyle for 1,400 employees. We created internship opportunities for 40 people. We used some of your money and went and repaired what is going on with climate by planting 4,000 trees. We did all that, and we are back. And we also paid our fair share of taxes. To be a good steward, or to be a good citizen. And we are back to pay some dividend to you as a thank you for giving us the capital. I think that is a very good story. And when we do that, we also give them assurance that having given you this, I still have 300 basis points worth of capital to continue growing. So hold on. Next year, a time like now, we will come back and hopefully with something more. I think that's a solid story.
Fantastic. Let's close on the regional view.
Yeah.
The Sudan business.
Yeah.
How is it playing out given the risks in that side of the world?
So the South Sudan business is one that, in fact, Joshua calls it his most favorite business because of the character, the grit, the resilience of the team, that we have in South Sudan. In the grand scheme of things, it is a branch. It is not the biggest contributor, but the quality of earnings we get out of that business is the most enjoyable. When we started last year, oil was not pumping in that market. And I remember when we sat here and there was rumors that the force majeure from the north would be lifted. It was saying, will it happen, will it not happen? $2 million out of that business in profitability, I think is something that we celebrate. There is challenges. The war in the north is not gone. There's some conflict actually in parts of South Sudan itself. We are dealing with some capital pressure. As you may remember, we have the regulator has asked that we increase our capital, and we are engaging because we feel that that amount of capital is too high, and that's really what we've communicated to the regulator. So we are engaging with the regulator to find the future of that business. But as is today, very, very proud of the team that is there, the clients we serve, and the resilience that we show.
Are you moving the needle on the recapitalization conversation?
Moving the needle?
With the regulator in terms of the conversations. Are you making progress?
We are making progress, but it's slow.
Okay.
But what we are cognizant of is time-bound. The first milestone, for example, has come and gone. It was 31st December 2025. We're supposed to have $20 million. We did not put in that capital, and communicated to the regulator that we did not put that capital. It is the responsible thing to do. So the engagements we are having now with the regulator is we haven't put in the capital. We do not want to put in additional capital. Give us guidance. How do we operate? Because we have customers. We are, by the way, we started operations in South Sudan, working with the government of South Sudan before the country happened in 2011. So as Standard Bank and Stanbic Bank, we have a long heritage with that country. The best and the most responsible thing is to have very bold conversation. Joshua and I were in South Sudan in January with Mary, who leads our compliance team, and Fred, who leads the business there, to go and see the central bank to say, this is our situation. Now, we think the responsible thing is to have those conversations as candidly as possible. We get direction from the regulator.
I'm supposing you have submitted a counter proposal on where that capital upgrade should be at.
Yes, we did. I mean, if you think about it, you can draw some parallels. Before this change, the capital requirement in South Sudan was $1 million, if you think about it. 5 billion SSP, ballpark numbers, $1 million. If you think about Kenya, so that is a 5 billion plus or minus economy. Kenya is a $135 billion economy. Our capital demand, our capital requirement was $7 million before the changes that are going on now. When the changes we are making now are going to be fully in place, the ones that the central bank is driving, Kenya will move to about $77 million, which is a 10 billion shillings plus or minus that we're talking about. The ask from the Bank of South Sudan is $30 million. So a 5 billion versus 135, 30 million versus 70 million sounds a little disproportionate. And that is the conversation we're having. We're putting those things on the table to say, the government, the Bank of South Sudan, I think, and we have very good relationship, has an opportunity to relook at this thing and say, hang on, how do we help banks? Because they are playing a very important part in driving that economy. And that's our purpose in that economy.
Friends, unfortunately, we have to close this conversation at that point. When Dennis and I sit down, we can go on and on matters regarding the banking sector, whether it is local, regional, or international. We've been speaking to Dennis Musau, Chief Finance and Value Officer of Stanbic Holdings, and focusing on FY 2025 earnings. Keep it business defined for all the latest as and when it happens.